Okay, so in the last part, we looked at the techniques in determining fair value. Is either an entity is using income approach, or they are using market approach, or they are using the cost approach. You see that income approach is majorly doing the present value of future cash flows, discounted cash flow method. Market approach that uses market information, market data. But this market information and data, it now depends on which market. Because there are some markets that are active, where the asset itself, their prices are quoted there. You will see it. That is the price today of identical or similar asset. The prices are quoted. Why some market prices are not quoted? You just have to use the prices they sold a similar asset previously. That we call an inactive market, where the prices are not quoted, but you have market information of how much they sold a similar asset. I mean, I had an information in Mushin, somewhere in Mushin. For a very long time, their land was under 10 million. Under 10 million, 9 million, 7 million, 8 million, 11 million. There was a year, one guy just bought a land, 60 million. The guy paid 60 million. They captured that market information. No, since then, that happens to be the benchmark. Except if they are now desperate to sell. They now say, okay, bring 45 million. And you know that 45 million might not necessarily be the fair value for us, because considering that the price of a similar asset recently was how much? 60 million. It is an inactive market. So the only market information we can rely on is price of a similar what? So we just have to then tailor it to the characteristics of the assets and some other information. For that reason is why we are talking about fair value hierarchy. Because we need to be able to understand as accountants which one is reliable and which one is mostly reliable and which one is least reliable. So this fair value hierarchy is now putting them into the most reliable to the least reliable in terms of levels. So the one with the highest level, we believe that that is the one that is very objective, and that is the one that is mostly reliable. Okay? So there are three levels here. There are three levels here. The level one, this one uses quoted prices. Quoted prices in an active market. That's level one. And this one is the most reliable. This is the approach that we recommend. Quoted prices in an active market. Level one. So which approach uses this level one out of those three approaches? Market approach. From here, we believe that market approach is the most reliable, and we encourage it. IFRS 13 discourages any other approach. It encourages market. If you can get market information, is the best, is the most reliable. Then there is level two that talks about using observable data of a similar asset in an inactive market. In an inactive market. That's level two. Observable what? Observable data, or they can call it observable inputs either data or input. It's the same thing. So observable data of a similar asset in an inactive market. I think this is clear. So which approach uses this? And that's correct. Market approach and cost approach. Income approach, there's no DCF approach. It's income approach. Okay, just that the method uses DCF. So the ones that use level 2, market approach, there's that other part of market approach that uses level 2. Cost approach, using replacement cost, is also observable data because it's something we can see. Everybody knows how much they sold this one. So they are observable inputs of a similar asset in an inactive market. Level 3, they use unobservable data or inputs. That is the company's internal information or data. Using the company's internal information or data. That is level 3. We do not encourage this at all because they are unobservable inputs. Unobservable input is not recommended. And which approach uses this? Income approach. Abi? That's the one that use DCF because they are using the company's data. They are where they look at, okay, what's our revenue for the next 5 years, right? That's your data. Is determined by you. You are the one that is saying, next year I will make 5 million. Upper year I will make whatever. That's level 3 in this hierarchy. So when we talk about fair value, you also need to be able to identify which level so that we will know whether it's reliable to us or not. Because for us, we expect you either use level 1 or level 2. Because IFRS 13 says that when determining fair value, an entity must maximize the use of observable inputs and minimize so we really do not want using unobservable inputs. So level 1 and level 2 is what is encouraged. So this is a statement carved out from IFRS 13 that when you are determining your fair value, we must ensure that you maximize observable inputs and minimize minimize it as much as possible, except if you have no choice. That is when you can be using your own company's data. And that's fair value hierarchy.